Asian markets are mostly higher as the reading for China's November factory activity fell short of expectations, dropping to the lowest reading since April this year. Oil rose for a third day as investors counted down to an OPEC Plus meeting that may see the group agree to cut production. Locally, Fairvest delivered its first annual results since merging Fairvest Property Holdings with Arrowhead Properties in January to form Fairvest, which is the largest SA-focused REIT. Looking ahead, Fairvest expects the significant increases in interest rates during the year to have an impact on earnings for the 2023 financial year. Meanwhile, shopping centre owner Hyprop Investments is the latest property company to list on A2X Alternative Exchange, following the likes of Storage, Fairvest and Growth Point. To talk to us about the latest when it comes to the markets, we are joined by Chantal Marx, who is from F&B Wealth and Investment. Chantal, thank you so much for your time. Where you have an environment where investors are weighing China's COVID policy and yet at the same time we're looking ahead to Fed Chair Jerome Powell's speech, how are you assessing global market sentiment right now?
Oh, wow. Global market sentiment is positive, but it's still cautious. There's still a lot that needs to happen from a monetary policy perspective globally, and in particular in the US, before I think investors will become too comfortable. So for the time being, the market is being run up by optimism that this zero China or zero COVID policy in China will come to an end sooner rather than later. And then also in anticipation of a less hawkish Federal Reserve. That said, financial conditions loosening this way, markets going up this way and becoming really excited about the prospects of a Fed pivot could result in the Fed actually becoming more cautious and opting to be more hawkish just in order to rein in that positive sentiment a little bit. That you don't want a situation where inflation expectations continue to increase because the expectation is that interest rates will decline sooner or too soon. You would want inflation to come back to that 2% level in the US before indicating to the market that a less hawkish stance is appropriate.
It's so interesting because yesterday you had US consumer confidence figures where consumers were less upbeat about buying big ticket items for the next 6 months, which gets you thinking about the South Africa situation and the state of our consumer. On that note then, what's your assessment of SA retailers in the environment that we find ourselves in?
So I think we are due for a pretty tough year ahead. Interest rates have increased quite substantially already, and we are still expecting interest rate increases into at least the first quarter of next year. This results in discretionary income being a little bit lower for households. So they will still spend money in areas like food and personal care, but they might rein in expenditure on discretionary items like clothing and luxury goods. So from an SA perspective, I think near term, you could see some pressure on the clothing retailers, where the food retailers, for example, will continue to benefit from higher prices. So my preference in the sector at the moment is definitely in the food retail space as opposed to the clothing retailers.
You and I have spoken extensively about the US yield curve, especially when you look at the 2s and 10s. But then when you look at the global yield curve inverting for the first time since 2000, what signals are you getting from that? Does that mean that we're going to go into a deeper recession, or does that mean we are, close to a recession?
So the inversion of the yield curve simply indicates that a recession could take place. Generally, it tends to be a pretty good predictor of recession. But what you need to consider is that the chances of a global recession are quite elevated if the chances of a US recession and a European recession is elevated. So at the moment, our base case isn't necessarily that the US will go into recession. They could come close to entering recession, but if they do, then it could be bad for global growth in general. I think what the market isn't really pricing in at the moment, or it's actually just starting to price in the possibility of higher than expected growth in China because of an earlier than expected opening up of that economy. Some real actions and steps being taken at the moment in that country in order to get rid of zero COVID. And I think a full opening up of China could see the global economy avert recession. But then again, I mean, it's all dependent on what they decide from a political perspective in that market. And of course, if the US avoids a recession or not. We do think that the UK and Europe will definitely enter a recession next year.
There's been a lot of talk about market positioning, especially around the risks. Going into 2023, what are some of the risks you're picking up?
So we are also still in the camp that's quite cautious going into 2023, particularly because markets have kind of run quite hard over the last month or so, probably ahead of where they should be, given that inflation levels are still quite elevated. A recession is still a possibility in the US and interest rates are still going up. And those are probably going to be the risks as well. The biggest risk is going to be interest rate risk, interest rates continuing to go up because inflation is higher than anticipated. And then, of course, there's also the possibility of policy error from the large central banks. Perhaps they haven't waited long enough for the impact of those higher interest rates to actually filter through to the real economy and bring down inflation. So these aggressive rate hikes might hurt the economy the global economy next year, and certainly the economies of the countries in which rate hikes have been quite aggressive, including our own.
When it comes to the dollar, where are you when it comes to the debate about whether we've reached peak dollar or not?
So I do think that the kind of weakness that we've seen in the dollar over the last month or so has really been a function of that optimism around inflation having peaked. But again, I think that if you get any sort of increasingly hawkish rhetoric or a reoccurrence of hawkish rhetoric from the Fed, you could very well see that reverse. And at the same time, you will also see weakness in equity markets coming through. So, I mean, I wouldn't be too optimistic yet. I do think that we are at a point where where we can start looking through this interest rate hiking cycle, but there's still a lot of risks out there. So I wouldn't be surprised if we see renewed dollar strength in the face of a more hawkish Fed because of financial conditions having loosened as much as they have.
Before I let you go, it's midweek. What other events are you paying attention to for the rest of the week?
Okay, so I think that it's going to be a quiet week for the rest of the week. I think all eyes are going to be on Fed Chair Powell's speech that's due to happen during the course of the week. I think it's actually this afternoon. So that's going to be quite important. We're also going to get details in terms of the Pala saga coming through from Parliament this week. I know that the President has submitted his report today, but I think that tomorrow we are going to get news as to whether or not there's a prima facie case that he needs to answer to. So from political risk perspective locally, I think that is something that we'll definitely be focusing on. But in terms of SENS, thankfully, it has quieted down. The team can start breathing again, and not really much more to look forward to Thursday and Friday.
Chantal, thank you so much for your time. That is Chantal Marks from FNB Wealth and Investment. And just to elaborate on that consumer confidence figure, it's quite interesting to see that consumers are still upbeat when it comes to the labor market, which has been quite resilient in the face of a Federal Reserve that is increasing interest rates. That is it from me. I leave you with Nompumelelo Siziba. We'll be with you until 3 p.m. Goodbye.